Welcome. Let's take a look now at some more of the charts and work out where markets are going. We started May, of course, with a bit of fragility in some of the trades, but broadly speaking, in the context of where we've come from, there really hasn't been much move. We're off now to Zurich to join a regular interviewee, Serge Berger from thestudytrader.com. Serge, welcome. Look, these markets at the moment continue in the longer term to go sideways. How do we make money in these markets? What's the forecast? What are you looking at in terms of some of the big charts at the moment, such as the S&P 500?
Yeah, hey Jeremy, it's very much a macro environment, right? Where the as I always say, it's the dog that wags the tail, not the other way around. I think what people are starting to wake up to, and this is more on the retail side, they're starting to wake up that they haven't made money in a couple of years, and so if we start off with the first chart here. It's just the S&P 500. We can look at the DAX as well. But basically, if you look at that green line, if you look at all the way to the left of that green line, that's where the S&P was in literally 2 years ago. Now you can see we're in the same spot. So yes, we've moved up, we've moved below it, but we've gone absolutely nowhere. And so when we talk to clients through our client base, whether that is on the investment management side or on the research side, they're just now starting to wake up to the fact that they haven't made any money. You can take this a bit further and start to kind of, look at, the sort of the NASDAQ 100 names, which is, the big sort of tech names. A few of them are basically carrying the market. These two have essentially done absolutely nothing since, the past two plus years. Yes, they've moved up, they've moved down, but really we've gone absolutely nowhere. And in fact, most people are actually underperforming this. So most people are actually down now because they were chart chasing the non-profitable tech stocks or something in the crypto space that has now, of course, had drawdowns. So that's kind of where we are. So the question, of course, is if the broader market, is doing nothing, what are sort of the outperformance and the underperformance names? And a lot of people have kind of started buying into this narrative that it's tech that's in a new bull market. And yes, year to date, certainly tech has actually outperformed. The problem is that, or just not the problem, just the reality is that we're actually starting to see now underperformance of the tech sector. So if I take the equal weighted S&P NASDAQ 100, which is tech basically, and divided by the equal weighted S&P, you can see that there's really no outperformance for the past 2 years. So tech has not outperformed. And even though that's this point here, all the way going back 2 years. And even though we've had an outperformance year to date, we're now recently have actually seen underperformance. So year to date outperformance, but over the past month or so, actually underperformance. So the long story short, we're going nowhere, and we probably won't go anywhere for a number of years probably.
Okay, so the big question is what does need to change to stir something in these markets for us traders, either up or down? I mean, we've got what appears to be a mispricing of the markets on expectations for US interest rates. We heard recently from Jerome Powell this week suggesting that there's no chance of an interest rate cut. My understanding is the market is still looking at an interest rate cut this year. The situation is, of course, about if rates do stay high, we then potentially get more of a chance of recession, which is going to presumably steer markets lower. What do you want to see to give you the catalyst or the blue light to start trading these markets again?
Well, I mean, we are being proactive. It's just we're being proactive more on the interest rate front. The way these cycles tend to work, and I think just a lot of people have kind of forgotten that, markets are cyclical and economies are cyclical. And what tends to happen is we've had sort of an interest rate shock over the past 18 months or so. What we tend to see after the interest rate shock is credit problems, and those are starting to rise. It started all the way in the UK with the pension crisis last October, and then it went into commercial mortgage-backed securities. We're now seeing it in other parts of the market. Of course, the banking crisis is going to now lead more and more towards that. So most likely what we're going to start to see is credit problems arise, and then that's probably going to keep the Fed from hiking rates further. And it just depends how severe that is. And that's kind of, when I talk to clients and trading desks and investment banks all day, that's kind of what everyone's watching out for, is how severe will those credit problems be. The number one focus really that is going to drive a lot of things on the equity side is probably the dollar. We've, I think, mentioned it last time when we were talking about a month ago, and we highlighted where the dollar index is right now. So this is basically the dollar index essentially against the big currencies, the euro, the yen. So given the sort of inverse relationship between equities over the past number of years and the dollar, if the dollar were to find footing here, you could see equity prices go lower. So dollar index, anything, below kind of where we are right now. So if it starts going, roughly around below 101 and starts gaining momentum, would probably mean tailwind for equities. If the dollar index starts pushing above 103 and higher, you're still gonna start seeing pressure for equities again.
How does all this translate into other areas of the market, such as gold? Because that is one area of the market where there is movement, and there has been obviously people making money on the upside. The big question is how much higher this is going to go, and is it dependent on the direction of the dollar?
So the way gold tends to work, it's largely dependent on the real interest rates. So that's your nominal interest rate minus the inflation expectations, and we are seeing real interest rates coming down as a function of interest of not only rates going lower, but also inflation, yes, going lower, but at a slower pace. So basically, just from the optics here tell us pretty clearly that gold is probably going to go quite a bit higher. I just have an ETF here. I'll quickly show you the actual sort of gold prices. So to us, the next levels here are just notably higher. I'm going to say 3, 4, 5% very quickly. Gold does tend to be choppy, so we've now reached the upper end of its range that it's been in since August 2020. And so the question is the third or maybe fourth time, is that going to be the charm? Our own proprietary trend following algorithm has now had gold in a bullish trend since February. That's the green background color. We kind of map it, from going from bearish trend, which is the red background color, into neutral, which is the black background color, and then into green. So you can see gold is in a bullish trend right now. That's the green background color. And are now getting the second buy signal. So we do think that this is likely going to start going higher again. But just do mind that it's choppy.
Yeah. Let me just steer the conversation back to where we started and take a look at the markets and ask you the question in the context of what we're seeing at the moment on the S&P 500. Can the same be said for us on this side of the Atlantic? If we look, for example, at the German DAX, are we looking at a sideways trading market there? And if that's the case, what's going to kick that out of that trading pattern? Is it the same dynamics? Are we looking at the currency markets? We're looking at rates and other supporting factors for the markets? Or is there something else at play on this side of the Atlantic which could well give us a different dimension in terms of trading opportunity?
Yeah, for sure. I mean, I think if you just look at the cyclicality of the economy and, again, much higher interest rates, it's going to be very difficult to imagine the DAX making any sustainable all-time highs. I mean, you can make all-time highs that won't be sustainable. Here, too, just pulling up the DAX, you can see essentially we've gone nowhere since, essentially, again, 2 years ago. That's May 21. You can see, yes, we've dropped. We're not coming back. But really, the folks that are, in their pension funds that are owning this, there's been no money made, maybe some dividends and things like that. Maybe there were some covered calls, but really it's flat. I have a really difficult time seeing the DAX really break out sustainably, just given the cyclicality of the economy. Again, much higher interest rates. So think about that, what that means for refinancing your debt if you're a company or, folks at home. So probably better short than a long here at this point from sort of a multi-month perspective. But again, just understanding where we are in the economic cycle, it's difficult to see sustainable breakout right here, right now for the DAX.
Yeah. Let me just pitch one final question to you, which is not really technical. It's more of a sort of a fundamental analysis part of the markets. To what degree is the U.S. debt ceiling talks, the discussions around that, how much of an important factor is that now in the markets over the next few weeks?
I think it's very important. There's a lot of different factors coming together in the month of June. One of them, of course, being the debt ceiling in the U.S. And right now in the United States, we have a very split sort of partisan sort of population, and Right now, I think markets are not yet pricing in what could happen, and they're going to bring this down to the wire, and then ultimately make it that they'll agree on it. But I think the odds right now are that we're going to overshoot, and really this becomes a problem, and there'll be the credit default swaps, by the way, in the U.S. has risen dramatically. So they'll ultimately come to an agreement, but there could be quite a bit of drama before long. Of course, if you think about it politically, ultimately, the current administration does not want this to ultimately turn into a complete disaster and them defaulting on debt. That won't happen most likely. So they will ultimately give in and say, okay, yes, But I think we could see quite a bit of drama. So expect more volatility. The VIX, by the way, is not pricing that in yet. The VIX at 20 is still way too complacent, in our view.
Yeah. Fascinating. Okay, look, we'll leave it there, but thanks indeed for joining us. Serge Berger from thesteadytrader.com. Just a quick reminder on that business about the debt ceiling. The BBC has recently written articles saying that the debt ceiling has been raised, extended or revised 78 times since 1960, and I don't suppose there's any real doubt that it's not going to be revised again this time around to give the market some more headroom. That'll be in the next couple of weeks that all that is decided. That's Serge Berger from thesteadytrader.com, joining us today on Charting the Markets.